Well, with 75 now off the table, it seems, is there a greater degree of comfort for investors that a soft landing is more plausible?
I certainly think there's definitely hope. It really seemed that the market reacted quite strongly when Chairman Powell said that 75 bips wasn't going to be in the future and that we should be looking for sort of 50 bip hikes for the rest of the year, potentially four. So I think just removing some of the uncertainty obviously is helpful for getting some of the cash that has been on the sidelines back into the markets, whether it's bonds or equities. So that's now whether we end up with a soft landing. I'm not going to make a call on that. I know the Fed is trying their best to make that happen. We've already had 1 quarter of a contraction. It's possible that could also be the second quarter of the year could also continue contraction. We're really not sure. Obviously, Powell was talking about how strong the U.S. economy is. But for the soft landing, I'm still up in the air on that point.
And as you pointed out, we saw buying across both sides, whether you're a bond investor or equities. Does it feel like volatility is only going to stay away in the short term, though? And if so, how do you navigate that? Do you kind of really pull more cash into action?
Right. So, we've been trying to figure out when the bottom of, particularly in the equity markets, would be within the U.S. markets. And if you were a growth investor, you did break the previous March lows just a few days ago in April. It certainly felt like there was these capitulation days where it's 90% selling, 90% of the stocks are down. And today, being so positive across all asset classes, whether it's small cap, large cap, growth value, everything was up. It feels like it could be the turning point. Now, obviously, there's only been 2 hours of this buying going on, so it's a little early to call, but certainly there are a lot of fingers that are crossed that are saying that maybe we'll return to more rational beings. Obviously, there are some stocks that are still highly valued. We know that Amazon was very disappointing, lowered guidance. I think companies that disappoint that are highly valued are still very risky. And so we have a much heavier tilt towards value and preferred stocks to be more defensive, because I still feel that there is still a fair amount of risk in those higher growth, higher value names as they have to adjust to a slowing economy.
So which sectors do you go to find that value?
So healthcare is one of them. Look, we're in energies and utilities. Right now, we are so defensive. Dividends, stable, low beta is still looking very attractive and still has, good value. Materials is another one that did very well. So you could simply do a simple, straightforward value ETF. You could do the typical value sectors and sort of X financials, because financials is the one sector that has been holding back the generically value stocks, or looking for a pure value style.
Are you factoring in the strength of the dollar? Because, of course, today we had that biggest plunge in about a month or so, but we have seen significant strength, especially against other currencies like the euro or the Japanese yen. When you're looking at these companies and their margins, is that something that factors into your calculation?
Not right now. I would actually love to be looking at sort of those more nuances around fundamentals. Right now, there is still so much fear and so much volatility across all asset classes, whether it's gold, bond, equities. So it's more of a tactical allocation at this point, rather than looking at how strong the dollar is. I think if we got into those types of nuances versus worrying about the recession, I would be so happy.